In September 2008, the financial world witnessed a collapse so sudden and catastrophic that it sent shockwaves across global markets. Before September 2008, Lehman Brothers was a symbol of financial prowess and stability. Within hours, it turned into the epicenter of a crisis that left the world in economic disarray. What drove this colossal institution to its knees? In this video, we will look into the Lehman Brothers collapse and the story behind the 2008 financial crisis, and we'll explore how a series of high-stakes decisions led to one of the most dramatic failures in financial history. Background on Lehman Brothers. As the 19th century drew to a close, a small store in Alabama would eventually leave a profound impact on global finance. Lehman Brothers began in 1850, founded by Henry Lehman and his two brothers, Emanuel and Mayer. Initially, the business was a modest dry goods store where they sold everyday items to local customers. But it was not long before the Lemons found themselves in a unique position to pivot their business model. In a stroke of entrepreneurial brilliance, they adapted to the economic climate of the South, which was deeply tied to the cotton industry. The brothers began accepting cotton as payment, and soon, their business evolved from a simple retail store into a significant cotton brokerage. Their move into the cotton market was a game changer. By facilitating transactions between cotton farmers and manufacturers, Lehman Brothers transformed into a vital player in the cotton industry. They expanded their operations to New York, where they played a crucial role in establishing the New York Cotton Exchange. This was just the beginning of their evolution. As the company grew, they ventured into new areas, marking their presence in various industries. The firm became involved in underwriting for notable companies like Sears, Macy's, and Woolworth. These ventures showcased their growing influence and adaptability, setting the stage for their eventual transition into investment banking. Through a series of strategic moves and successful partnerships, Lehman Brothers solidified its reputation as a leading financial institution, paving the way for their future role in the financial world. Rise to prominence. In the early 1980s, the financial landscape was about to witness a dramatic shift. Lehman Brothers, once a prominent name in the financial sector, was acquired by American Express in 1984. This move was a significant one, valued at $360 million. Under American Express, Lehman Brothers was integrated into the company's investment banking division. This partnership was not merely a corporate merger, but a strategic alliance that aimed to bolster both entities. The influence of Lehman Brothers within American Express was substantial, allowing it to expand its reach and capabilities within the investment banking world. Fast forward a decade, and Lehman Brothers was ready to reclaim its independence. In 1994, the company was spun off from American Express and became a publicly traded entity once again. This decision marked a new chapter for Lehman Brothers, setting the stage for its rapid growth throughout the 1990s and early 2000s. By the year 2007, Lehman Brothers was at its zenith. The company reported record profits with earnings exceeding $4 billion, a dramatic increase from just 5 years earlier. Their stock price soared to an all-time high of $86 per share, reflecting their dominant position in the financial industry. These milestones underscored the firm's remarkable rise and its pivotal role in the global financial market, setting the stage for the dramatic events that would follow. The 2008 financial crisis. A financial system built on risky loans and high-stakes investments suddenly collapsing under its own weight. This was the reality of 2008, a year that exposed the fragility of the global economy. At the heart of this crisis was the subprime mortgage market, a sector that had once seemed like a golden opportunity but soon turned into a ticking time bomb. Subprime mortgages were loans offered to borrowers with poor credit histories, who would otherwise not qualify for conventional loans. These loans were often accompanied by adjustable rates, meaning that the interest rates could change over time, typically increasing significantly after an initial period. This setup created a dangerous scenario where many borrowers faced payment shocks, unable to keep up with their mortgage payments as rates soared. Lehman Brothers had heavily invested in this volatile market. The firm was deeply involved in real estate and had aggressively bought up subprime mortgages. This risky strategy seemed profitable while the real estate market was booming. However, when the market turned and housing prices began to fall, the impact on Lehman Brothers was catastrophic. Many of their borrowers started defaulting on their loans, and the value of their mortgage-backed investments plummeted. To understand the scale of the problem, it is essential to grasp how mortgage-backed securities function. These securities were financial products made by bundling multiple mortgages together and selling them to investors. The idea was that as long as homeowners continued making their payments, these securities would be profitable. However, when homeowners began defaulting on their mortgages, the securities lost their value rapidly. Lehman Brothers held an enormous amount of these securities, minus $76 billion worth. As defaults increased, the value of these securities diminished sharply. The risks associated with these investments became apparent, and Lehman Brothers found themselves with massive financial exposure that they could not cover. The resulting losses were devastating and contributed significantly to the firm's eventual downfall, highlighting just how interconnected and fragile the financial system had become. The collapse of Lehman Brothers. In the high-stakes world of finance, the allure of quick profits often blinds people to underlying risks. For Lehman Brothers, their ambitious strategies and high leverage created a precarious situation that was about to unravel. At its peak, the firm had borrowed excessively, using leverage to amplify their investments in real estate and mortgage-backed securities. This approach, which had once seemed like a savvy move, began to backfire as the real estate market soured. Lehman Brothers had accumulated substantial debts, betting heavily on the continuous rise of property values. When the housing market collapsed and home prices dropped, the value of their investments plummeted, and their massive debts became unmanageable. The firm found itself caught in a vicious cycle where the devaluation of their assets led to increased financial strain, further exacerbated by their need to cover enormous debts. This overleverage, combined with a rapid decline in asset values, severely compromised Lehman Brothers' financial stability. As the financial storm intensified, Lehman Brothers' situation grew increasingly dire. The company struggled to find a solution to their mounting problems. In September 2008, the situation reached a critical point. With their stock price plunging and no viable options for a rescue, Lehman Brothers filed for bankruptcy on September 15, 2008. This move marked the largest bankruptcy filing in U.S. history, with Lehman Brothers' debts totaling over $600 billion. In the days leading up to the bankruptcy, there were frantic efforts to find a solution. The government considered various options, including potential bailouts and the possibility of a rescue by other banks. Despite these attempts, no agreement was reached, and Lehman Brothers' fate was sealed. The bankruptcy not only marked the end of a historic financial institution, but also sent shockwaves through the global economy. The failure of Lehman Brothers exposed the extent of the crisis in the financial system, setting off a chain reaction that would plunge economies worldwide into turmoil. Impact and aftermath. The news of Lehman Brothers' bankruptcy reverberated through financial markets like a shockwave, causing immediate and severe reactions. On the day of the filing, the Dow Jones Industrial Average plummeted by 500 points, the largest single-day drop in 5 years. This dramatic decline was not just a reflection of investor panic, but a clear signal of the broader instability that the bankruptcy had unleashed. As the dust settled, it became apparent that the failure of Lehman Brothers was only the beginning of a much larger financial crisis. The collapse sent ripples through the financial system, leading to a severe credit crunch. Banks, now wary of each other's financial health, drastically reduced lending. This had a cascading effect on businesses and consumers, further exacerbating the economic downturn. The crisis spread beyond Wall Street, impacting economies worldwide. Countries saw their financial markets falter, businesses struggled to access credit, and unemployment rates began to climb. In the wake of the crisis, significant reforms were introduced to prevent a repeat of such a disaster. Governments and regulatory bodies around the world recognized the need for stronger oversight and more robust financial regulations. In the United States, measures like the Dodd-Frank Wall Street Reform and Consumer Protection Act were enacted to improve transparency, enhance accountability, and increase consumer protections within the financial industry. These changes aim to address the systemic risks that have been exposed by the Lehman Brothers collapse and to restore stability to the global financial system. As Lehman Brothers' downfall reverberated through the financial world, it left behind a landscape forever changed. The events of 2008 not only reshaped financial markets, but also sparked widespread reforms to prevent future crises. What lessons do you think were learned from Lehman's collapse, and how have they influenced today's financial practices? Share your thoughts in the comments below. If you found this story insightful, don't forget to like, subscribe,